Market Catalyst, I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, we'll have the latest on the economic front as JOLTS data crosses the wire. Plus, we'll look at 40 so-called forgotten stocks that investors might be overlooking. And for today's ETF report, we'll dig into artificial intelligence and the ETFs to watch to capture that momentum this year. Let's take a look at the major averages here on trading day number 4 of this new year. We've got a mixed picture. The Dow little changed after its record close yesterday. The S&P 500 little changed to the upside, and the NASDAQ little change to the upside as well. So not seeing a lot of big moves there on an index level basis. What's interesting is once again today, we have healthcare as the outperformer to the upside in the S&P 500. Remember we talked about yesterday, the drug makers rallying. That XLV is up 1.5% today, dragging things down. We've got materials and financials. So a little bit of a balancing act going on today. We continue, of course, to watch big tech. CES, a lot of announcements out over the past few days. NVIDIA showing continued strength, up 1.3% today. And we see a mixed picture elsewhere within big tech today. So not necessarily seeing the momentum go in one direction. Let's talk about that JOLTS data that I just mentioned. It is indeed crossing the wire. U.S. November job openings coming in at 7.14 million. The estimate was for a higher number of openings, 7.64 million. The quits rate at 2%, so that's an uptick. The level of quitters, 3.16 million, above the estimate of under 3 million. So these jobs numbers may be showing a little bit of more weakness than the ADP report would have indicated this morning. It is a little bit of a lagging number here when we're talking about JOLTS, so that's something to consider as well. And again, not much change from all of this. We're going to have to wait for the big jobs report on Friday. But let's talk more about the U.S. labor market now. It is maybe showing signs of stabilizing. You've got that ADP data on the one hand showing that U.S. private employers added 41,000 jobs in December. Those gains essentially erased November's losses. Then you just had the JOLTS data. You got the big jobs report on Friday. What does all of this mean? Let's put it together with Chris Watling, Longview Economics global economist and chief market strategist. Chris, it's good to see you. I guess, we've been trying to read the tea leaves here for a little while because the government shutdown. Even the last jobs report was not high quality, according to a lot of economists. So we've got the data that we got today. We're going to get the data that we're going to get on Friday. What are you expecting from all of this in terms of the picture?
Yeah, hi Julie, great to see you. I think the picture's pretty clear. The labour market has been softening over the course of the last sort of 4, 5, 6 months. And yes, the month by month the data sort of ticks up a bit or disappoints or whatever. That's not too important. I think the trend is quite clear. If you look at ADP private employment on a 6-month moving average, it's running at about plus 20,000 a month. So there's no doubt the labour market's slowing. You can see it in lots of other data, private sector surveys and so on. Look at the ISM employment indices. So I think it's more of that K-shaped economy. It's more of the bottom half of the US economy that's struggling. And it's clear that, the labour market is a part of that tough gig out there. So yeah, look, it'd be interesting. I mean, the data with the government shutdown is kind of a bit all over the place in terms of the payrolls, but it'll be interesting to see what the trend looks like when it comes out later this week.
Yes, it very much will. And so not only do we have sort of diverging stories maybe when it comes to where people are in the economy, but also diverging stories in terms of the data itself, right? Because you do have the weakening job market on the one hand. On the other hand, as you pointed out in a recent note, a lot of the economic outlook looks pretty strong here. So how are you kind of weighing those different sides of things going into this year?
Yeah, I mean, there's this sort of debate out there is really is sort of capex versus consumer, particularly the sort of bottom half of the consumer. And clearly to get the bottom half of the US consumer going, you need lower bond yields. And therefore you need to get housing going and get a sort of wealth effect and some sense of more consumption momentum coming into the economy. But to get those lower bond yields, you probably need some softening of the capex, or maybe you just need lower inflation. But clearly, capex has been very strong last year, and in 2024, there was some fiscal stimulus in 24 at the end of Biden, with a bit of sort of overhang into 25, and that kept bond yields elevated and interest rates higher. And of course, tariffs added to that last year. The Fed was reticent to cut, and that that kept the yield curve up as well. So all of that, I think, has made it tougher for the bottom half of the economy, for the old economy, for housing, for the industrial cycle. And the economy's been sort of dominated by this AI theme and the capex related to it and data centers and so on. So really the circle is squared, I think, by inflation. And if we see our view, and I think this is perhaps one of the most important top-level factors in US and global macro next year, our view is that inflation will surprise to the downside in 2026. And if correct, we should get more rate cuts out of the Fed than people expect and lower bond yields. So you could really get an economy pretty juiced as we go through this year, because you can have the capex and you can have the sort of consumption starting to improve as housing picks up and bond yields move lower. So this is what I call having your cake and eating it. But there are definitely challenges, but I think they can be overcome in 2026 if I'm right about inflation.
Yeah, it's like another version of the Goldilocks here. Okay, so what does that inflation outlook hinge on? How are we going to get that lower than expected inflation?
Well, I think inflation was masked last year by tariffs and global goods prices. So if you look at US durable goods inflation, it added alone, it's only 11% of the total index of CPI anyway. It added 60 to 70 basis points to headline CPI over the course of the last 12 months. Now, I think that's going to roll over. I think that tariffs distorted that. China is really the sort of price setter of global goods prices, and China's in a lot of trouble. It's still in a balance sheet recession. It's struggling, hasn't got enough stimulus, so it's going to export more deflation. So I think you've got all that going on, and you've also had money that's been too tight for housing. So you look at the Zillow rental index. It's basically almost at zero. So rental inflation's gone, house price inflation's gone in the US. The oil price is down a lot. All the labor market's easing. All the traditional inflation factors would tell you there's not really much pricing power out there. So I think we'll see that come through in the data in 2026 as the sort of tariff effect rolls off and as goods prices ease over the course of the year and service prices continue to ease. So I think that's the key here. We've squeezed out the COVID inflation from 22 through to 25, and now we can see what's really going on in the economy in 2026. So it's going to be an interesting year.
Yes, it will. Chris, there's something else I want to ask you about with regard to inflation. And this has nothing to do with core inflation, but it has to do certainly with what the prices that people pay. I'm talking about energy prices. And I bring this up because of what's going on in Venezuela and some of the swings that we've seen in oil prices. Most of the folks I've talked to still expect not to see a big lift in oil prices this year. But I'm curious what you think on that front, given some of these geopolitical uncertainties.
Well, we've been bearish in oil for the last 12 months, and we stay bearish. And the reason we've been bearish is really because there's a ton of oil around. There's loads of supply. And, I mentioned China not really firing on all engines, and demand's been pretty weak across the globe. So there's plenty of supply around. And yes, Venezuela's kind of interesting, but it doesn't supply that much oil into the world market at the moment. It might do in a few years' time if the infrastructure gets rebuilt. But it clearly, it's not a major factor as we stand today. So, I think you can always get big spikes on oil on geopolitical concerns. The rumbling over Greenland is kind of intriguing, I suppose, that it could affect the oil price. Intriguing and troubling, I suppose, in some ways, I say, as a European. But yes, I think really the oil price has tons of oil out there. It should remain under control for at least the first 6 months of the year. Eventually, if we get the global cyclical recovery we're looking for later in 26 into 2027, then maybe you'll start to see the oil price move and put a floor in. But for now, I think the oil market's very well supplied.
Well, as a European, I want to end on this, and that is the Eurozone inflation also came in better than expected, right? We just got that data out earlier today. And so are you optimistic about the outlook, not just for inflation, but for growth in the EU and in the UK, for that matter, for this year?
Yes, we are. We think growth can accelerate in both economies. And I think that inflation trend that we talked about in the US is really pretty similar in the UK and the Eurozone as well. I mean, the Eurozone's got less inflationary pressure for various reasons, but the UK, actually a lot of the UK data, the unemployment rate, the goods inflation, the rental trends, they're all the same as they are in the US at the moment. So I think in the Eurozone and the UK, inflation can be below what people expect. And so I think it's a Western theme and it keeps rates pinned lower and going lower in the western part of the world.
Chris, good to see you. Happy 2026. We'll talk again soon.
Good to see you. Thank you, Julie.
Thanks. Coming up, forgotten stocks that you may want to consider adding to your portfolio this year. That's according to our next guest. You're watching Market Catalyst. We'll be right back. Boyar Research is out with its annual list of 40 stocks that they believe are positioned to outperform in the year ahead. They call it the Forgotten 40. This year's list has some repeat picks like Uber, along with some new picks like Airbnb and Berkshire Hathaway. Joining me now, Jonathan Boyar, Boyar Research president, to talk about some of these picks. Now, just a framer for folks, you're a value investor, so you're looking for stocks. When you say Forgotten 40, it's stocks that you think are good value, and maybe the time horizon I think is a little bit different than your normal methodology. So walk me through that real quick.
Yeah, absolutely. Normally we're long-term patient investors. We look at things on a 3 to 5 year basis, but for the Forgotten 40, it's a little bit different. We look at what's going to make the stock go up in the year ahead. So the list and the report is full of catalyst-driven ideas. So they're not our cheapest names, but our names that we think will outperform.
Gotcha. In that shorter term time horizon, when we're looking sort of broadly at these sort of, I guess, value stocks of any size, what are some of the macro catalysts you think in the year ahead? Because I know some of these guys have specifics, but I'm curious what your higher level thoughts are on that. Yeah,
no, we try our best to ignore the macro as best as we can, just because it's almost impossible to predict who was, Liberation Day wasn't on many people's bingo cards, so it's hard you really want to do the best to ignore it, but you also want to look at things like when we're talking about the Atlanta Braves holding some like tax law changes that are coming into effect in the coming years that serve as a catalyst.
Okay, so you talked about Atlanta Braves, so let's dive right in and talk about the Atlanta Braves. And this is one, for anyone who has watched Yahoo Finance and has seen your appearances before, this is one that you have liked for a long time, and you've brought it up. It hasn't done so well over the past couple of years. Yeah. So what's going to change this year for this one?
Yeah, no, it's been a disappointing pick, but I think this could be the year. There's a tax law change coming into effect starting in 2027 that basically your top 5 employees can't be deducted for income tax purposes. This puts them at a huge competitive disadvantage versus their privately.
And just sorry to interrupt. So when you say top 5 employees, you don't mean like necessarily the CEO. Yeah. If it's a sports team, it's the top paid employees, which in many cases, probably some of them make more than the executives at the company, right?
Exactly. So basically, they can't deduct it for income tax purposes, so their profitability goes down significantly, and they're at a huge disadvantage to the other teams, which don't face that same law. So it's Atlanta Braves Holdings, which owns the Atlanta Braves, is controlled by media mogul John Malone, and he's famous for avoiding taxes legally for any way possible. So we think this could be an impetus for him to sell the team in the coming year, as sports franchises are hot, and he might as well try and ring the cash register. He's also simplifying his empire, as you've seen with Charter, et cetera.
Right. And so it could potentially go private and wouldn't be subject then to that tax change you're talking about. One of the stocks on your list that I don't think we've talked about before, at least, I'm not as familiar with, is called Markel Group. Mm-hmm. And this is a diversified company, owns a bunch of different types of businesses. What is it about this one? Yeah, it's a baby Berkshire. Essentially, it's run by Tom Gaynor. It has a terrific long-term record. It attracted the attention of activist JANA partners. They're doing things to help unlock value. They're essentially an insurance company. They're buying back a lot of shares. It's trading about $2,000 a share. We think it's probably worth $3,100. Okay, gotcha. And what, again, is the catalyst here JANA? Is that they're pushing for something that's going to change operationally?
Yes, making the insurance stronger and buying back a lot of shares.
Gotcha, okay. Cooper Companies is another one, and this is a healthcare company, healthcare supplier, makes contact lenses, makes women's health products. Healthcare, a lot of investors like healthcare going into this year, although many of the folks I've talked to are talking about drug makers. But what are the catalysts going forward for this one? Like
Markel, there's actually 2 activists involved. what we think they should do is split the business in two. They have a dominant contact lens franchise where they have 25% of the market. We think that should be split from the women's health because it really makes no sense to have them together. So we think that could be a catalyst going forward, plus better capital allocation.
Uber is one that I know that you like. The stock did well last year. So again, this is not your traditional beaten down value play that you're looking at here. But Uber, more recently has been a little bit more challenged after a surge for a lot of last year. So what's going on here? What's going to change for Uber to give it more upside this year?
Yeah, Uber was on last year's list. It was up roughly 40%, but in the last month or two, it's had about a 15% drawdown on fears of robo-taxis and autonomous driving. We think they're a beneficiary, not a victim of robo-taxis. It's buying back a ton of shares. It's growing rapidly. We think it's a great long-term hold, not only for the year ahead, but for years and years.
Now, we're not going to get through all 40, obviously, but just to take a step back here and look at the performance of these forgotten 40 versus value last year, you guys outperformed the S&P Value Index and most other value measures with that 12.7% gain. But the S&P 500 was up 14%. So I'm just, I always struggle a little bit with value. I got to be honest with you, Jonathan, especially over the past few years, because folks like you, folks who do value, have made the argument for value. But growth has outperformed. So I mean, what do I do with this as an investor?
Yeah, no, absolutely. I mean, essentially, the S&P 500 right now is a technology fund for all intents and purposes. So you're making a very large, concentrated bet. This is a good diversifier, and if some of the Mag 7 stops being so magnificent, the S&P 500 should underperform, and value is a good place to be. And last year's list pretty much outperformed every value index out there.
So people should view it sort of as a hedge. Is that how they should be thinking about it?
I think over long periods of time, value is one of the best places to be in the stock market. I don't view it as a hedge. I think investors should be wary of the risks of being in passive S&P 500 funds and think of diversifying because, as I said earlier, it's full of technology names and is levered to 5 or 6 stocks.
That's worked out really well for them, though.
It works out well till it doesn't.
Yeah, I guess any investment is like that, so for that matter. All right, Jonathan, thank you so much for being here. Good to see you.
Great to see you.
Coming up, we're going to look at some of the top calls on Wall Street, as well as today's trending ticker. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Taiwan Semiconductor, Deckers Outdoor, and Wayfair. First up, Taiwan Semiconductor. Analysts continue to be bullish on the chip manufacturer, even after the stock is up around 50% in the last year alone. Goldman Sachs, Macquarie, and JP Morgan all raised their price target on the stock. And in a note to clients, the analyst over at JP Morgan said it expects 2026 to be another strong year with 30% revenue growth driven by AI demand and improving profitability. Next up, Deckers Outdoor. That's the footwear brand retailer behind brands like Uggs and Hoka. Baird and Piper Sandler cut their price target on the stock, while Piper Sandler also downgraded it to underweight from neutral. The analyst there said it's concerned about promotions as an unhealthy customer acquisition tool, plus potential conflicts going on between its direct-to-consumer and wholesale channels. There are now 14 buy ratings, 12 holds, and 4 sells on the street. And keep in mind, the average price target, it's at 110. And lastly, we're taking a look at Wayfair because Barclays upgraded the stock to overweight from equal weight. The analyst there believes Wayfair gains should continue this year, driven by improvement in its digital platform and the company's growth initiatives like loyalty. Also, the firm likes its exposure to middle-income consumers who are positioned to benefit from tax refunds this year, and also that limited impact of tariffs compared to what we saw just last year. There are currently 20 buys, 15 holds, and 1 sell rating on the street for the online home goods stock. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Mobileye, First Solar, and Strategy. First up, Mobileye, one of the top trending tickers on Yahoo Finance. The self-driving car company announced a $900 million acquisition of humanoid robot maker Mentee. And I'm joined by markets and data editor Jared Blickery to chat about this one. Now, Mobileye's been in focus at CES because there's been some talk about some new customers that it didn't reveal. And to be clear, it doesn't make self-driving cars. It makes tech that goes into self-driving cars.
Much like the name suggests, it helps your car see, Mobileye. And so that's really its main business model. And now they're getting into robots. And as you just pointed out to me before the break here, that the founder of Mobileye is also the founder of this company. So they share, there's a nexus there. Also, I just remind people that Mobileye itself is an Intel spinoff. Intel had acquired this company years ago. It didn't quite fit into their business model, so they got spun off.
And they still own quite a big chunk of Mobileye.
Yes, they do. And guess what? Uncle Sam owns a big chunk of Intel too. So there's a bit of circularity there. So this is kind of a new thing for them, and robots are cool. We'll have to see where this goes. But I thought we'd dial up the Wi-Fi Interactive and just show some of the charts. This is what Mobileye has done over the last year. So not that great, down 35%, and you can see plunging to new lows there. And I'll give you a max chart, since inception, since their IPO a few years ago, and you can see they're right hugging those lows right there. So they need something to kind of stoke investor appetite again. And to be fair, they just came off of some inventory adjustments with respect to the auto companies, manufacturers who buy their products. China has been a rough spot for them. So they're trying to turn things around. And this is just, an interesting story that got us talking about it.
Yes, for sure. And it looks like analysts are pretty positive on it as well. They think that this makes sense. We should point out Mentee, which is the name of the company it bought, it doesn't have any product on the market yet. It's been around for about 4 years. It's been developing different robots, and these are, it's my understanding, they're designed to help build stuff, right? Whether that is Mobileye's tech itself or other kinds of tech.
Yes, the pictures I saw, they look humanoid, and so not all robots are designed in our image, but these are.
These are, but again, they're not on the market yet.
Yes,
they're still figuring it out. All right, let's talk about First Solar here because it's leading declines in the S&P 500. Jefferies has cut the company to hold amid tariff risks as well as its valuation and some questions about its sort of long-term strategy here. So interesting call that's really having quite a big effect. It was Julian Dumoulin-Smith over at Jefferies who downgraded. It's just a downgrade to a hold, by the way, but we're seeing the stock down 9%.
Well, let's go to the chart first because I think this kind of informs as to why Jefferies is putting that hold on. They say, and look at this nice run. That's since the post-Liberation Day lows right there. The stock has had a nice run, and that is all that's baked in right now. So that is impressive off of those lows, up 23% over the trailing year. I'm going to show you a max chart here, and I know Jefferies is not making a technical analysis call, but I will point out that this company IPO'd in 2006. Within a couple of years, they reached their all-time high, and this was very recently tested, not only once in the preceding years, but also within the last year. And so there's a technical ceiling here, and the stock is going to need a new catalyst to drive beyond that. But First Solar has enjoyed relative outperformance from some of the other solar manufacturers because they are not in the business of necessarily outfitting your home. They're more of an institutional play.
Right.
They also manufacture in the US, so it kind of aligns with the Trump's America First strategy. And the other interesting thing is that solar did very well in the first Trump administration, and that was not expected.
Right.
And solar has actually done pretty well in fits and starts, and it depends on the company, but it's also done well over the last year. So it depends. You got to pick your company here, but I think people looking for that America First angle probably might have stumbled on this stock, and then again, it has some technical hurdles here.
Right. And the analyst says that the visibility into bookings next year is just not great, and so that's one of the reasons why he's downgrading. He said, if you looked at 2025, the company cut guidance, had margin compression, but the stock kept going up. And he thinks that the policy support is not necessarily going to be there this year. So,
especially in an election year, yes.
Yeah, exactly. Midterms. All right, and then let's talk about strategy. Those shares are getting a boost. The MSCI is pausing its plans to exclude digital asset treasury companies from its market indexes. Now, to give a little bit of background on this, so MSCI is one of these big companies that makes big indexes,
yes.
and they have rules around those indexes. And there had been talk that they were considering excluding digital asset treasuries entirely. Now, this would be bad because when a company goes into an index, a lot of money follows it.
Passive flows, just automatically.
And Strategy has pushed back, and other digital asset companies, DATs, have pushed back forcefully against this rule change. It doesn't seem like it's entirely off the table, but they're not doing it right now.
Yes, and to be fair, I don't know how much the MSCI weighting, or whether or not they include them in the indices, is going to really provide that incremental bid on MicroStrategy. Because if we go to the Wi-Fi Interactive, I just want to point out that this is a levered bet. This company Strategy is a levered bet on Bitcoin. So I have an ETF here, which is iBit. That's my Bitcoin proxy here, and you can see that MicroStrategy is down 53% over the last year versus Bitcoin down 5%. And they really started diverging last year. And one thing I've noticed, and I'm going to defer to my technical analysis here. One thing I've noticed is that Strategy, when it is leading either to the upside or the downside, that is a direction you'd kind of want to be in with respect to Bitcoin. So I would look, I'll pull this up on a 1-month chart. You can see Strategy is still leading to the downside. Once that turns around, that to me is a good sign that it's time to buy Bitcoin. But as far as inclusion in the index, I mean, you can go either way there. I don't think the passive flows are going to help it that much. I think when people are excited about Bitcoin, they buy Strategy, and that is what propels the stock.
Well, I think it would be different if we're talking about the S&P 500 in particular, because there was also chatter at one point that it might be included there. That could provide a little bit of more meaningful upside.
Yeah, you're going to get a lot more funds tied to the S&P 500 through VOO, SPY, et cetera. MSCI, for all the work they do, they just don't have the same cachet or the same assets under management.
Right. Well, and most of their indexes are bigger, so there's just more stocks in it, so it's less incremental for the individual ones too.
Very well said.
Well, we'll see what happens. Jared Blickery, thank you so much.
Thank you.
Coming up, we'll talk about the outlook for energy stocks amid the upheaval in Venezuela. That's next on Market Catalyst. The U.S. ouster of Venezuela's president has raised questions about potential impacts on global oil markets. This comes as the U.S. reportedly seized a sanctioned oil tanker in the North Atlantic. Yahoo Finance's Josh Lipton spoke to Brian Kessens, Tortoise Capital Advisors Senior Portfolio Manager and Managing Director, about his outlook.
Brian, it is great to see you. I do want to start on Venezuela because I'm interested to get your take there, Brian. Maybe start by framing it for us. How important, Brian, is Venezuela now to the global oil market? And what would it take to remake and rebuild it so it became a more meaningful, significant supplier in the years ahead?
Yeah, great question, and thanks for having me on today. And I think you characterized it well when you asked, what is it, how important are they now? Now they produce about 1 million barrels per day, which is significant, but when you look at the global market for oil, it's a little over 100 million barrels per day. So we're talking 1% of overall production. It's almost a rounding error as it relates to today. What gets people excited, though, is where they were 20 years ago when they were 3 million barrels per day, and overall oil production was a lot less. They were a much more meaningful impact. And the sense maybe is that they can have that level of exposure on the global market again.
But for what I'm reading, Brian, we're talking about really a serious lift here in terms of rebuilding that oil market and oil infrastructure.
It is, and I think that we saw some of the market reaction yesterday to some oil stocks, and I don't know that it fully understands it's going to be $100 billion, at least 5 to 10 years before we really start to get material gains from a production perspective as it relates to Venezuela.
And when we talk about Venezuela, we talk about heavy crude, Brian, right? For maybe those who don't follow this market as closely, this industry, in simple terms, what do we mean by heavy crude, and what are the economics there?
Yeah, so it is a heavier crude, or almost a lower quality crude. It has more sulfur in it. It moves more like molasses as opposed to like a vinegar, like a light sweet crude moves. It's more similar to the Canadian oil sands than the crude that comes from the Permian Basin. And because it is heavier, it is harder to refine. And many, many years ago, the U.S. recognized this. Hey, we have an advantage, proximity advantage to both this Canadian and this Venezuelan crude. Let's build our refineries so that we can process this lower quality crude in a better way. And because it's lower quality, it's cheaper. it can be anywhere between 10, 20, at times even $30 per barrel cheaper than a light sweet crude like a WTI or Brent.
There's been a lot of hot talk about this, particularly out of Washington, but do you see U.S. oil majors, Brian, moving back into Venezuela aggressively? What will it take to get them to move back in aggressively?
Yeah, I think for them to aggressively move back, I don't see them aggressively doing it. I think if they do it, they're going to be very deliberate in how they do it. First off, they're going to have to understand what the political environment is. They don't want to see any risk at all that their resource is once again nationalized potentially by Venezuela. So they want to understand, first and foremost, what are the rules of the game and how long can those rules of the game last? And then secondly, hey, how economic can it be for them? Today, oil is between $55 and $60 per barrel. You know, the break-even costs for Venezuela are a little higher than that. So I think that we're going to need to see a move higher in the overall price, the market price for oil before they're going to.
And that price, so WTI, it was like at 57 last I checked. Yep. Where do you all see that kind of moving near to intermediate term?
Yeah, in 2026, we think that a range for it, certainly where we're at now, but somewhere between $60 and $70 per barrel is where we see it ending the year. I think in the first part of the year, we're a little bit oversupplied to 300,000 barrels per day, maybe even a little bit more time. But once we hit the summer driving season and demand starts to pick up, it'll become clear again that I think we're going to add about 1 billion barrels per day or more of demand throughout the course of 2026. I think supply will be a little bit more restrained. And in the back half of the year, I think, though, supply and demand will be in much better balance.
So Venezuela, basically, we're saying important geopolitical event you don't see as a kind of a near-term market driver for now?
Not over the near term.
Okay.
Not at all.
Let's get to some places where you do see opportunity, get to some picks, Brian. Williams Companies, ticker WMB. Why is that a buy here?
Yeah, we're big believers in natural gas and in natural gas infrastructure. If we look at natural gas from a demand perspective, in the U.S. alone, we're going to export more natural gas in the form of LNG next year. And in fact, we're probably going to add 10 to 15 BCF per day of LNG export between now and 2030. And then AI, we talked about it on your previous segment a lot, and the power needs for it. We think the majority of the power generation is actually going to come from natural gas. So that's another source of demand. Williams has arguably the most strategic pipeline in the U.S., going from the Gulf Coast up the Atlantic seaboard actually into New York City here. They can build a lot more laterals off of that. And they've taken an approach where they are comfortable supplying the data centers themselves, with not only the natural gas, but potentially with the power as well. I think there's a great opportunity in Williams.
Final pick, I want to squeeze this one in here too. Energy Transfer. Now that stock is down, it looks like nearly 20% over the past 12 months. You think that's an opportunity? Yeah, we do.
We think Energy Transfer from an asset footprint, it's unparalleled amongst anyone else, especially intra-state Texas. They too are in the natural gas infrastructure game. They are going to benefit from the data center build out too. They trade with a yield upper high single digits right now. They just came out actually this morning with forecast for 2026. Their guidance, it was above street expectations. We think that as they prove their story out, the cash flows come through, that they'll be rewarded.
Brian, appreciate your time in those picks. Thank you, sir.
Thank you. My pleasure.
Coming up, we'll bring you the top ETFs to watch in the AI space and beyond, how to play the market this year through ETFs. Stay tuned. You're watching Market Catalysts. Strategists on average are predicting more gains for stocks this year, with AI remaining a dominant theme and expectations of easing policy rates. We're looking at how to play it all in this week's ETF report, brought to you by Invesco QQQ. Kristy Akullian, head of iShares Investment Strategy Americas at BlackRock, is joining me now. Kristy, it's good to see you. And I want to talk a little bit first about the sort of backdrop that you're expecting for this year. Then we can get into sort of how you get into it with ETFs. Sure. What's sort of the base case there for how this year is going to play out?
Yeah, absolutely. And it's nice to see you. Happy New Year. I think the way that we're thinking about the economy and how that translates to markets is pretty constructive. A lot of the fiscal impulse and the fiscal expansion that was enacted last year should actually take place this year in terms of some of the tax cuts. And we're continuing to see deregulation as well. We expect rates to fall, as does the market. So all of that put together kind of makes a nice blend, if you will, in terms of risk taking. Certainly not to say that there aren't risks. We're watching the labor market pretty closely, as I know the rest of the market is as well. But I think that overall we are pretty constructive, and we go into this year pretty optimistic as well.
And I wonder, this is something I've been trying to sort of get my hands around coming into this year, is the role of AI in people's portfolios, right? It seems like there is still some bullishness, but I'm also hearing a lot about diversification. So how are you talking to people about that sort of portfolio construction piece and how much they should be including AI?
Yeah, absolutely. I think the short way to think about this right now is that we still think that AI is the best game in town, but it's no longer the only game in town. And that's a really big change from what we've seen over the last couple years. So if you look at, the overall market, and if you kind of decompose returns and valuations, we actually saw technology and communication services, sort of the broad AI basket, get cheaper over the course of 2025, which I think was surprising to a lot of investors because AI companies were able to grow earnings more than they grew their prices. So we still see a lot of opportunity. BAI, the BlackRock AI ETF, is still, we think very early days in the deployment of AI. But to your point, investors are looking for other sources of income as well. AI has been the dominant driver of earnings income and earnings growth over the last 3 years. But for the first time, we're seeing more of a broadening out of earnings growth as well. So even just as simple as looking at sort of growth versus value within the S&P 500, we've seen value go from about 2% earnings growth in 2024. It delivered 8% earnings growth in 2025, with expectations for about 12% growth in 2026. It's still below the about 20% we're expecting from growth. I think the big takeaway for investors who are looking for diversification within their investment or within their equity sleeve is that it's a lower opportunity cost to be diversified now than it was when AI was the only game in town. So we're not only talking to investors about BAI and being, and the BAI ETF as being a targeted way to get that AI exposure. We're also talking about things like DYNF, which is our factor rotation ETF. It's our largest active ETF here at BlackRock. It's not just a value or a growth story. It's a value and a growth story. It's also a momentum story. So other ways to get earnings growth from other parts of your portfolio, I think are really appealing opportunities in 2026.
Kristy, I want to linger on the point that you made for just a moment, because I think it's a really important one. And it's not as though value earnings are going, the acceleration is going to match what we're seeing in growth, is what I hear you saying.
Yes.
But the gap
Correct.
is closing enough that diversifying won't cost you as much as it would have last year or the year before, et cetera. Is that the correct summary of what you were saying?
Yes, exactly. We still expect the strongest earnings growth to come from the growth cohort of the market, and frankly, still to come from AI. But the fact that we are seeing growth elsewhere is really encouraging because we like broader in terms of a rally, and exactly what you said. There's a lower opportunity cost to being diversified now than there was in the last 2 years, which is a really important and new characteristic of 2026.
Of course, we got to talk beyond stocks as well, because or at least different flavors, right? Because I know BINC is something you guys have talked a lot about. That's one of your ETFs that is sort of more income focused as well. So when you talk about diversification, I know you guys at iShares like to talk about this one.
Yeah, absolutely. We still see tremendous opportunities in fixed income. We are more focused or more prioritized on the income side of fixed income rather than expecting, rates to drop more than expected and principal appreciation there. So BINC, the BlackRock Income ETF, as you mentioned, I think that one of the reasons why this appeals so much to investors is because it targets the plus sectors. It's the things that you probably don't own already if you're invested in sort of a core bond index or a core bond ETF. So I think, you're getting access to securitized assets. We have a pretty constructive view on emerging market debt as well. We're aware, that corporate credit spreads are fairly tight. So this isn't just an investment grade or a high yield story. I think it's taking a broader purview of the bond market and finding opportunities there where the income is still really attractive. And BINC is a great way to do that.
Kristy, I mentioned at the top that strategists are pretty optimistic this year. I know you guys in your survey work have found that individual investors seem to be pretty positive as well. And so does it sort of become, in some cases, a self-fulfilling prophecy, right? If they're optimistic, they're going to take on risk and they're going to buy stocks.
Yeah, I mean, I think that's a fair characterization. Certainly, sentiment matters in terms of performance of markets as well. We do find from our surveys that most investors are bullish. There's gradations of how bullish they might be, but that can be a positive setup for the year ahead. Really interestingly, we took another survey just yesterday. So in light of some of the events that happened over the weekend, we asked investors what would be the biggest motivation if they were going to make changes to their portfolio this year, whether it was going to be hedging against political risk, seeking income, or hedging away from the AI trade. More than half of the investors that responded said that it's diversifying within the AI trade. So really interesting that we don't see investors wanting to move away from that. We just see them wanting to access different parts of it. So, we talked about diversification. I think it's certainly, Warren's mentioned, emerging market equities, particularly emerging market equities in Asia is something that we're focused on as just a complementary way to access that AI trade within your portfolio if you're very concentrated in some of the US AI stocks, but it's just a different part of that overall theme. And I think that's what investors are really thinking about as we come into this year.
A lot of choices to make for 2026. Kristy, thank you so much. Really appreciate it.
Of course. Thanks for having me.
Take care. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming.